Good afternoon, everyone. I welcome you all to ET Energy World webinar. To present this webinar, I welcome Mr. Hemal Zubalia, partner, Deloitte India, and share valuable insights on the topic Would Budget to 2019 Empower the Energy Sector? There will be a presentation on the topic followed by a question and answer session wherein you may submit text questions to today's presenter by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will collect those and address them during the question and answer session at the end of the presentation. Now I request Mr. Hemal Savalia to start the presentation. Over to you.
Good afternoon, everybody. We are I would say, at the cusp of interesting things happening in the energy sector. And all of us are waiting to see how the budget 2019 kind of empowers the energy sector as a whole. While there are kind of two views going on, whether we will see a budget being a full-fledged one or will we see an interim one, nonetheless, whether it would be a budget that makes the changes or supports energy sector now, or it would be a budget once the government comes in either case, I feel it's very important that the government looks at the needs of the energy sector and brings in those changes that are required to empower the energy sector. With that opening remarks, the way I would like to go about over next 20 to 25 minutes is briefly speak about what is the energy outlook, what are the key challenges from a tax perspective, and last is what should be the way forward, or what is it that we look in terms of concluding remarks. If I look at the energy outlook, interestingly, the overall, we have given some figures there. In March 2018, as we were at, for power as a whole, we were at 243 gigawatts. As in December 2018, it has jumped to 650 gigawatts. The desired level could be higher, but interestingly, if one looks at the renewable energy, the Prime Minister himself has come out with a stated policy to increase the renewable energy usage. And as we see that in March 2014, the renewable energy portion out of this 243 gigawatt was only 12%, which has now jumped into 21% out of the 350 gigawatt. That is a substantial rise, and I see that increasing as we go along. It would be still lesser than the stated targets on the renewable energy. Having said which, to my mind, it is a good jump from where we were, i.e. from 12% to the 21% where we are. Coming on the petroleum side, in a short span of 2 years, that is 2016 to 2018, the consumption of petroleum products has increased from 165 MMT to 206. And similarly, on the gas part, also we see the jump from 140 to 159. Overall, on an energy outlook perspective, especially, we would see that on the renewable energy, we presume that the use of renewable energy would keep on increasing. On the petroleum side, a lot is dependent on the outside prices, as we are the net importers. Having said which, there are also a lot of plans by the government to promote, say, for example, setting up of refineries in India, and therefore putting more focus on domestic generation of petroleum products. Coming to the key challenges that we face, and some of it is, if one was to say that what should we are asked from the finance minister as one sees the budget 2019 being presented. I would like to break it up into three parts. One is how does one rationalize the tax rates? The second part, which is very important, as we see more and more asset coming in, people are also looking to monetize their asset. So typically they would sell their existing developed or constructed asset, use the money that they get to develop new assets. So I thought we would spend some time on talking about the asset monetization and issues in and around that. And lastly, uh, I thought we would also speak a bit about simplifying compliance and reducing litigation, because at the end of the day, this is something that impacts our day-to-day, operations of the business. So that's how we laid out. And if I may now go to the first part, which is on rationalize tax rates. Today, we have two tax rates. One is we have a 30% tax rate for corporates plus surcharge and education cess. And we also have a 25% tax rate. As you all will recall, the finance ministry had in his earlier budget mentioned that the overall objective is to bring down this 30% tax rate to 25%. And the finance minister has gradually gone about it by first bringing in small companies whose turnover was less than 50 crores. Then that turnover limit was increased. So now, whichever companies turnover is less than 250 crores are eligible for 25%. But all the other companies, the corporate tax rate is 30%. And when you add the surcharge and the education cess, it actually increases over 34%. If we look at the ASEAN countries, our neighboring countries, everywhere the tax rate is much, much lower. And while the government or the finance minister has taken the first step of announcing, I believe that he should ensure that in 2019, the promise that was made of reducing it to 25% should be equally applicable to all the cases. And mind you, friends, this 25% rate also, when you add the surcharge and education, goes up to effectively over 29%, which to my mind is high, and which also therefore leads to people trying new avenues of, say, tax planning or tax avoidance. Uh, Rather than that, we would rather prefer if the tax rate is brought down to more reasonable or ASEAN levels, where the total effective rate is 25% or lower, is what our ask would be, especially for the energy sector. The other interesting point is on the investment linked deductions. These energy sector is a capital intensive sector. It requires a lot of investments. Historically, for example, the renewable solar sector and the wind sector were entitled to accelerated depreciation, which was 80%. What the government did a couple of years back is to remove that benefit, and all, not just for renewable energy, for all others, the profit linked incentive schemes were done away with. But for everybody else, they were moved on investment linked deductions. Just for some of you who might not be familiar with this terminology, in case of profit linked, your entire profit is exempt, say for a period of 10 years, irrespective of your cost base. Whereas in case of investment linked deduction, till the time you don't recover your investment, you don't have to pay tax. It's only after you have recovered your investments you start paying tax. So in other words, an investment linked deduction is nothing but getting your full capital cost as a deduction or depreciation in year one itself. To my mind, this is an important deduction or a benefit, and it should have been extended even to the renewable sector, because all other cases where the profit linked incentives were withdrawn, the other cases did get the investment linked deduction, whereas for renewable energy that wasn't the case. And we have seen some of this, even though at one hand depreciation is nothing but a timing difference, but on the other hand, the time value of money really impacts the IRR in quite a few cases, and therefore to that extent has a very important bearing on the overall business decision. If I move on to the third point, is there is this growing debate that on one hand the incentives have been withdrawn, then do you really need a minimum alternate tax? And even in that case, the minimum alternate tax, which is as high as 20%, there is hardly any difference between the MAT rate and the normal corporate tax rate. And I believe it's time has come that in cases where, anyways the incentives are withdrawn, we do away with MAT and just keep a low corporate tax rate. One may question that, once the incentives are withdrawn, do we really see a big difference between the book profit and the tax profit? The answer to that is, once the accelerated depreciation or any incentives like the investment linked deduction that I just spoke about is kind of not available to the sector, at times we do still see there is a difference. Essentially, at times, in quite a few cases, we have seen Ind AS being applicable. And because of the Ind AS, the book profit is represented in a different fair value based, whereas from a tax perspective, it could give a different result. But nonetheless, the company still ends up paying MAT. Or for that matter, if there are past losses which are set off, even in those cases, there are MAT implications. So to that extent, when all the incentives are withdrawn, to be fair to the energy world or the energy sector, it's about time that the MAT is either reduced to a very nominal value or is completely eliminated. Let me come to the next point, which is an interesting point. In most of these, in the energy world, we see separate SPVs being set up for separate projects, whether it is for power or in cases of oil and gas, in terms of projects. If it is a service company, then it would be a single SPV. But if it's project oriented, you typically end up having multiple projects, project companies. And the reason for that is a variety of things. One is from a lender perspective, you would want to ring fence each project separately. Therefore, you need separate companies. Sometimes, in case of certain PPAs, it is required, it is mandatory to have a separate SPV. So that, while for commercial or regulatory reasons, you would create separate companies, what it throws up is that, on the tax side, you face a lot of problems. And the reason for that is you might have a peculiar situation that there is a tax loss in one company, whereas a tax profit in another company. And while it is a same group that is owning these separate companies, ultimately your effective tax rate when you look at on a consolidated accounts basis is much higher than 30% or 35, because on a consolidated basis your profit and losses get knocked off, but from a tax perspective you still end up paying taxes on profit, whereas the losses will be set off only at a later date. So interestingly, when we look at some of the other countries in the West as well as in Asia, they have a concept of group tax consolidated, or let's say as a group level of being taxed as one single unit. I believe for the energy sector, this is an extremely important requirement or initiative that the government needs to take, because as we have seen on budget after budget, we have seen that the finance minister cites that under the BEPS action plan or so and so country, they have introduced some laws, and based on the same, in India, we try and introduce something similar. So while there are new laws being introduced to garner more revenue, I believe something like a group tax consolidation is very important for the energy sector. And currently it is prevalent in more than 25 countries. Developed countries, whether it's US, UK, or developing countries, we have Singapore and other Asian countries also having. And there are there are concepts in which you can share the group tax relief. But from a macro perspective, the larger point that I'm making is to allow people to set off the losses and profit, or for that matter, even MAT credit lying in one company which is not utilizable in the other company. So it's probably the time to kind of look at these avenues which would support the energy sector, especially when at the end of the day everything is owned by the same promoter group or by the same MNC company. Let me move on to the points on the right hand side of the slide, which are essentially on the indirect tax. As we know, petroleum products and the natural gas products are outside the GST net. And to that extent, in terms of it being outside the GST net, creates a lot of input cost, which is not creditable on the output on the GST side. There's already growing voices saying that these products should be brought within the GST net. While this is not purely a finance bill subject, because that's going to be driven more by the GST Council, I believe that at least for natural gas and for ATF, which is outside the GST net, that's something that should be considered to be brought within the GST net. Because we have seen that for airlines, ATF is a significant cost component, and all the indirect taxes that are paid on the ATF they are unable to claim the credit, which just makes the overall cost, the tax cost for operations, very high. The other interesting point that again the Finance Bill 2019 should consider is on waste to biofuel plants. As we see, there is a lot of municipal waste in cities across India, and there have been newer technologies to convert this waste into biofuel. As we interact with various companies, we see that there is a lot of good technology available from overseas, which can be brought to India, and these plants can be used to convert the waste into biofuel in a very efficient manner. Currently, there's a custom duty which kind of makes the entire transaction expensive. So you would have a custom duty basic at the 10%, and plus you would have IGST or GST of 18%, which just kind of doesn't make it very attractive proposition for people to import such high-end plant and use it for converting waste into biofuel. To my mind, this is a very important initiative for a cleaner environment, and therefore the government should bring in the custom duty exemption. The other area that we see is in relation to the natural gas. In case of natural gas, because it's not part of GST, it is subject to VAT, and different states have been, applying different VAT rates ranging from 5% to as high as 20%. Like in the state of Bihar, it is 20% on natural gas. This kind of such a large variance, defeats the whole purpose of, treating India as one market, one nation. Uh, to that extent, we believe that there should be a declared good status for natural gas, which in essence will ensure that there's a uniform rate of 5% applicable to natural gas. And that would ensure that we have a level playing field and it's uniform. Again, while currently it's outside the GST net and it's being subjected to each VAT at each state level, I believe for natural gas, this would be an important initiative for the natural gas sector. Last point that we see, honestly, it's not specifically for the energy sector, but we have seen this playing a very important role, and we are quite hoping that the clarification comes in this relation. As you know, in the energy sector, we do have people, the projects are in variety places across India. We do see people traveling, but what we have seen is, say, when a person is on a meeting in the state of Tamil Nadu, there's a hotel, there's a conference you attend, or you hold a conference, you pay, GST because the hotel is in that state, the place of supply is in that state. Now, typically you will get the credit, but because if you do not have any output services liable to tax in that state, your input credit is basically lost. This is an issue, surfaced by even the other industries, and I do believe that the council should look at this and come up with a clarification that in case of hotel, it should be more where the service recipient is located as distinct from where the hotel is located. But we are yet to see as to how it takes shape. These were our some of the challenges that I mentioned and the recommendations that we would have from a tax rate perspective. Let me now move on to the second part, which is on facilitating the asset monetization. If I broadly look at asset monetization, I see it in three parts as we interact with various corporates across India. One is in terms of outright sale of the asset. The other is we see that the company decides to go in for an IPO and therefore raises the public funds which they utilize for growth options. And the third, which is increasingly getting more and more attention, is looking at an InvIT structure where you create an InvIT and transfer your completed projects under the InvIT. I'll just spend a couple of minutes on just highlighting some of the issues or challenges and what are the suggestions. If I pick the first category, that there is an outright sale to the buyer. Now, what we have seen and a lot of times gets missed out is essentially when you sell you have two choices. Either you sell the asset or you sell the shares of the company in which the asset is present. In cases where you just sell the asset, uh, that company might have some carry forward credits, losses, which do not go along with the asset. Whereas in case you sell the shares, the losses in the company again are not eligible to the buyer because there are provisions under the tax law which says that any change of shareholding which is more than 50%, 51 to be precise, the new buyer will not get the benefit of past losses. To my mind, this just makes the cost of transaction more expensive. And at a time when we see that more and more developers are interested in monetizing the asset, possibly one needs to consider that if it's a genuine loss incurred by that company and if the shares are transferred, can they one look at allowing these losses or credits to be passed on to the new buyer? And thus, therefore, when one looks at the return on the asset after setting off such losses or claiming the credits, it becomes more viable. Another interesting point that we see is that as we see new PPAs or concession agreement, again, the promoter lock-in period in some cases we have seen is 1 year, in some case it's different. I believe that if it's uniform promoter lock-in period, it's something that would just kind of help. And if it's on the lower side, all the more better, because again, as we just discussed, what we are seeing in the marketplace is increasingly people are taking the construction risk, developing, but as soon as the project is completed, one is looking to monetize that and then put in that money to develop more projects. So to that extent, while this is not a pure finance bill related suggestion, this is more on the regulatory side that as we see more and more projects coming in, the promoter lock-in period should be uniformed and should be on the lower side. If I look at the IPO category, we have again seen a lot of companies trying to go in for IPO. In some cases, we have seen that depending on the capital market, the IPO actually goes ahead. In some cases, we have seen that it's been withdrawn. But in either case, as people go in for IPO, couple of points one needs to bear in mind is there has to be a greater governance. So typically, all the related party transactions or your quarterly accounts, and therefore, again, from a tax or a regulatory perspective, one needs to be extra careful in ensuring that not only uh, transactions are above par, but more importantly, there has to be an adequate documentation to demonstrate the governance mechanism actually is in place and is working. We've also seen that in quite a few cases, there is ESOPs given to the employees, which typically kind of get encashed once the IPO happens. There's a bit of the perquisite tax, which is quite comes I would say a cost element as one gets into IPO, and one needs to just factor in because if these ESOPs are encashed by the people just say probably few months before the IPO, what should be the value for perquisite purposes? Should we pick up, what is done by the valuer, or should we take the IPO price? Because at times, what does happen is that employees are paying perquisite tax and at a higher rate, and then when the IPO happens, actually the shares don't fetch that price. So unfortunately, it penalizes the employee rather than benefiting the employee because the employee would have already paid tax based on the perquisite value that is determined a few months ago before the IPO. If I now move on to the third category is on the InvIT side. As I said, InvIT is drawing a lot of attention, and the good part is that both SEBI as well as the income tax authorities are taking conscious attempts to resolve issues that are causing a hurdle for the development of InvITs. So, for example, whatever the promoter group or the sponsor transfers to InvIT, initially there was an issue of capital gains tax, then there was an issue of payment of MAT, but we have seen systematically the finance ministry actually making those amendments or giving those clarifications, and thereby, as and when the promoter is transferring to the InvIT, there is no capital gains tax. It's only at a later stage. But interestingly, what we have seen again is that when the promoter is trying to encash the asset by transferring the shares of the SPV and getting money in return, you are taxed at a higher rate of 20%, as distinct from if the promoter got units in the InvIT, which he encashes a little later, then it is taxes at the rate of 10%. So there's a bit of anomaly there. And I think that's something that could be amended or corrected in this finance bill as we see it coming. The other area that most of the infrastructure projects or energy projects are, the debt equity ratio is very high. In typically 75% is debt, 25%. The debt equity ratio required by SEBI was 49%. Of course, there has been a recent effort to liberalize to bring this 49% to 75% debt, and therefore at par with what the industry norm is. But also, we believe that at times for completed projects, once they are achieving COD and transfer to InvIT, we see the debt rising as much as to 85% also. So I think that's a point to bear in mind. I think there's already steps taken to bring the 49 to 75, but that's another area that one needs to bear in mind as one looks at InvIT as a model to monetize the asset. If I move on to the simplifying compliance and reducing litigation, couple of quick points. In terms of, we see that on the EPC, especially on the solar side, there is a reduced rate of GST, that is 5% GST for SPCG equipments or supply. And we had seen different players taking different view, and we did represent to the GST Council. We have seen that they came out with a via media, i.e., that 70% of the EPC contract value is considered as supply part, which is eligible for 5% GST, and 30% is liable at 18%. Because we saw different states and advance ruling given different judgments on this issue. So as the GST Council have brought down this 70-30 rule, I believe that this is a welcome because it gives the clarity. The only problem as we see the industry stakeholders facing is this split of 70-30, because in the actual value, when you look at the project cost, the SPGC, the modules and the inverter, the overall is not 70%. The actual value is around 80 to 85, especially if you import and or you calculate the safeguard duty. And therefore, this 70% should have been a little higher. On the prosecution notice, I'm sure you would have read in the newspapers, there has been a lot of notices issued on TDS not being paid on time or not deducted at all. And while the tax office has already given clarification that they are going only for the high value or people where the amount of default is high, what we see is that this is indeed a problem, and therefore we feel that people should take more care in terms of, is the right amount of TDS being deducted and is it paid on time. It's as we classically say, precaution is better than cure, and that stands true for prosecution a lot. We would also, there is for non-residents, there is an advance authority for advance ruling, which which typically as a stated time frame has got to deliver within 6 months, but practically it takes around 2 years. That's something that needs to be expedited to ensure that we provide clarity to the business people upfront, rather than, because then it defeats the whole purpose of having this advance ruling, because it's really not much in advance, it's more 2 to 3 years later. One more area that we see is that there have been a lot of intra-group funding, because as I started that there are multiple companies, and you see funding, funds being moved from one company to another. Today, there have been a lot of issues. There is, transfer pricing applicable. Under the company law, it has to be at arm's length. Under the tax law, there are some disallowances. Say you have borrowed money, you have invested in shares, there are some disallowances, or you have borrowed at a higher cost, lent at your lower cost. Uh, See, for the energy sector, as I said earlier, uh, the commercial need or necessity is to have multiple entities. And therefore, the government needs to look at slightly differently of the intra-group funding and give certain leeways in and around those, especially for the infra-related companies. So that was the suggestion on the table. And lastly, for the ATF, which kind of fuel that goes in for the outbound aircrafts, the suggestion was that today it's a very manual process where you need the clearance for the custom officer at the airport, you need for the fueler, and there's a three-level manual check or manual signatures required uh, before the aircraft can go. Practically, as we all know, the airlines is very time sensitive kind of business operation, and therefore rather than the manual, our suggestion or request would be is to convert it into more an electronic process, and which can have a specific time frame, i.e. that approval needs to be obtained quickly, as distinct from, or if it's not granted in that so much time frame, then it is deemed to be automatically approved. So that's something that on the ATF side, especially for the airlines, is what we thought is something that could be considered. Uh, with that, I kind of move on to the last slide that I have. And in terms of the last slide is that budget 2019 is the last budget before elections. While it is anybody's guess, as I said, whether it will be full-fledged interim or will it be more a political budget. But as I started off, the suggestions that we have tabled are very important to energize and empower the energy sector. And ideally, right now in the interim budget, but if not, at least in the full-fledged budget that comes in after the government is in place, these are something that should be considered, because that would really reduce the challenges that the energy sector, and they can focus more on the business part of it. So that's where I thought I would, in the given time frame, talk more from a macro perspective, the issues faced by the various stakeholders in this sector. I now move on to the questions, and as I see, one question that has come in is that 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 you have spoken about tax consolidation, and can you throw some more light on the tax consolidation part? So on the tax consolidation part, in terms of the uh, there are, as I said, there are different countries. In some countries, we have seen them allowing one single kind of tax consolidated tax return. So, for example, you would have 10 companies, you would file only one single tax return. I have personally represented before the ministry, and there were some challenges because we follow one entity, one PAN number. So some of the countries, like I gave you the example of Singapore, follows group tax relief. So 10 companies will file tax returns, 10 tax returns, but they're allowed to transfer their losses or credits from one or the other. So both these models are there, and different countries follow different. And honestly, I'm neutral to which of the models is more conducive, as long as it is something that can be brought in to into picture for the energy world. So I think that's was the answer to the first question. Uh, the other question is how can the tax computation for the solar developers be made more transparent and reliable? This question is by Varun Kumar. And I think, yes, Varun, this is an important or interesting question. As I mentioned earlier, especially on the SPCG 5%, we had different uh, we saw different companies taking different view, and therefore it was also making. I had questions from the commercial team saying that I can see my competition bidding for this project at a very different way because they have taken full benefit, whereas we are not taking a benefit, and therefore we are losing out to give a compelling bid price. So to that extent, I think it was good that the 70-30 principle came out. But to be fair, the corresponding issue is coming, the actual cost of supply which is eligible for 5% is actually in the range of 8%, 80% to 85%. So according to me, I think if the GST Council brings in to a more realistic level of 85%, it would be ideal as we go along to ensure that at least from a tax perspective, it's a level playing field. And it all boils down to how efficient you are from a business perspective. If if I can, there's a question from Jatinder, but I think he seems to have left. He said, could you share some of the major tax related announcements in the last year's budget? Uh, uh, as I said, I would not say last to last. So last year's, from the energy perspective, there were a few clarifications that came in. But honestly, the more radical one was the earlier one, where they removed a lot of tax incentives which were available to energy. And in some cases, those incentives from profit linked have moved to investment linked, which I described earlier. But in some cases, like the renewable energy case, from profit linked, it has gone down to the normal rate, i.e., the 40% depreciation. And therefore, to that extent, it's really going from one end to the other that has impacted the sector. The next one is what will be the impact, and this is from Prerna, what will be the impact of budget 2019 on decentralized renewable energy sector, that is eco, solar, biogas, or mini grids, etc. One is I would say that per se, I'm not too sure on this interim side, except for some of the major issues, whether the finance ministry will get down to the other areas. But I would say that except for the biogas one I mentioned about the customs part, okay, anything to do with cleaner environment should be a priority, and that's where we can hope that those changes could be brought about. Then there is a question from Himanshu. The question is, will both depreciation and business loss be disallowed to be carried forward in case of greater than 51% share sale? No, so the answer to that is no, both do not get impacted. So if you have unabsorbed depreciation, you're allowed to carry forward that unabsorbed depreciation, even if there is greater than 51%. But if it's unabsorbed business loss, then you are not allowed to carry forward if there is a change of more than 51%. So that's the answer to your question. Unabsorbed depreciation, you are allowed, but unabsorbed business loss, you lose out in case of change in the share. One sec, I'm just trying to. I think there are some questions more, but in the interest of time, I feel I would like to hand it back to the moderator, Subrajit, to give his comments and then close the session, because we were to end a little earlier, but I think the questions were interesting, so I just took some time more. Subrajit, over to you.
Yes, thank you so much. We actually, ran a little out of time, but however, the questions were really interesting and obviously a very interesting session. So thank you, Mr. Hemal Zobalia, partner, Deloitte India, for sharing valuable insights on the topic, Would Budget 2019 Empower the Energy Sector? Unfortunately, we won't be able to take all the questions due to time constraints. If you have any other questions, please send them at editor@etenergyworld.com. It was an engaging and insightful talk, and hope all the participants have enjoyed the session. The recording of this webinar will be made available on etenergyworld.com. Thank you everyone for joining us. Goodbye.
Thank you.